Welcome to PPTV. Your current speaker is Putri Shaira binti Muhammad Sharizad. You can call me Putri. You are now watching Financial News. Aeons is a leading retail and services company operating supermarkets, department stores, specialty shops, and malls. Its customer-first approach focuses on delivering high-quality products and services while fostering a long-term connections with the communities. Sustainability is central to Aeon's operations, emphasizing environmental conservation and social responsibility. Guided by its philosophy of pursuing peace, respecting humanity, and contributing to local communities. Aeons aims to improve living standards for its customers and stakeholders. With a strong presence in Asia, particularly Japan and Malaysia, Aeon is recognized as a trusted and innovative leader in the retail industry. Ratios play a critical role in evaluating a company's financial health and operational efficiency. For example, for performance evaluation, ratios like profitability metrics help assess financial efficiency over time. Second, attracting investors, which is metrics such as returning on equity and earnings per share are key indicators for potential investors. Thank you. Now, over to Ms. Nadia from NDTV.
Assalamualaikum. You're now with me, Nur Nadia from NDTV. We report on the liquidity ratios of Aeon Company, which include the current ratio and quick ratio. Now, based on the calculations that have been carried out for current ratio, in 2022, the Aeon Company had 0.497 cents of current assets for every 1 ringgit of current liabilities. This was slightly lower, showing a weaker liquidity position. Meanwhile, in 2023, the company had 0.513 cents of current assets for every 1 ringgit of current liabilities. This indicates a slightly improved ability to cover short-term obligations compared to the previous year. So the current ratio improved from 0.497 cents in 2022 to 0.513 cents in 2023. This indicates a marginal improvement in liquidity.
Assalamualaikum and good afternoon. My name is Julia Aisyah binti Maknali from SYTV. Today we are analyzing Aeon Company debt ratio, a financial metric that shows the proportion of a company's asset financed by debt. The formula is debt ratio equal to total debt divided by total assets. In 2023, total debt was 3,364,531,000 ringgit and total assets were 5,223,543,000 ringgit. This gives a debt ratio of 64.411%. In 2022, total debt was 3,619,295,000 ringgit and total assets were 5,426,323,000 ringgit, resulting in a debt ratio of 66.699%. The lower debt ratio in 2023 reflects better performance as it indicates improved financial stability, reduced reliance on debt, and better risk management compared to 2022. This demonstrates Aeon's financial progress while showing room to strategic borrowing if conditions are favorable for growth. Next, we are analyzing Aeon Company time interest earn ratio for 2022 and 2023. The TIE ratio measures a company's ability to meet its interest obligations and is calculated using the formula earning before interest and taxes (EBIT) divided by interest. In 2023, EBIT totaled 299,551,000 ringgit, while the interest was 105,613,000 ringgit. This gives a TIE of 2.836 times. In 2022, EBIT was 326,249,000 ringgit and the interest was 114,781,000 ringgit. The TIE was 2.842 times. The slight decrease in the TIE ratio for 2022 to 2023 indicates that 2022 was Aeon's best performance in terms of interest coverage. Conversely, 2023 is slightly riskier with a lower margin of safety to cover interest expenses. However, Aeon remains financially stable and capable of meeting its obligations. That's all from me. I will be right back. But first, let's pass it over to Putri from PPTV station.
Thank you, Ms. Julia from SYTV. Now, welcome back to PPTV. I will briefly explain the usage of inventory turnover, average collection period, and total asset turnover. Inventory turnover measures how many times a company sells and replenishes its inventory within a specific period. A higher turnover indicates efficient inventory management and strong sales. As a result, according to the calculation, Aeon's inventory turnover improved from 6.839 times in 2022 to 7.462 times in 2023. This increase reflects more frequent inventory replenishment, better inventory management, and stronger sales. However, while higher turnover is beneficial, it is essential to avoid stock shortages that might upset the customers. Overall, this improvement highlights Aeon's operational efficiency and better financial performance. Next, average collection period, where it measures how long on average it takes a company to collect payments from customers who bought on credit. A shorter period indicates faster payment collection. According to the calculation, in 2022, Aeon's average collection period was 8.13 days, increasing slightly to 8.55 days in 2023. While this indicates a small delay in payment collection, it might reflect more lenient credit terms to boost sales. However, this increase could impact cash flows and requires careful management to ensure efficiency in credit terms and maintain a strong cash flow. Last but not least is total asset turnover, which assesses how effectively a company uses its total assets to generate revenue. It is calculated by dividing total revenue by average total assets. A higher ratio shows better asset utilization. According to the calculation, Aeon's total asset turnover improved from 0.763 times in 2022 to 0.790 times. This increase suggests more efficient use of assets and higher revenue generation, marking a positive trend in operational efficiency. In conclusion, these improvements indicate Aeon's progress in managing inventory, assets, and credit terms, reflecting enhanced financial performance. Thank you. Now, I'll pass it over to Miss Atika from HATV. Hi!
Assalamualaikum. You are now with me, Atika from HATV, with a report on profitability ratio. I will explain profitability ratio. It's a class of financial metric used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet asset, or shareholders' equity. The first one is operating profit margin. We use formula which is operating profit divided by sales. So, for the 2023, the answer is 7.014%, and for the 2022, the answer is 7.803%. According to the calculation, Aeon operating profit margin declined from 7.803% in 2022 to 7.014% in 2023, indicating a higher operating cost relative to revenue, likely due to increased expenses or growth investment. Despite the drop, the margin remained above industry average, reflecting strong operational control amidst external challenge. Second is the net profit margin. The formula that we use is net income divided by sales, and the answer for the 2023, we get 2.781%. For the 2022 is 2.686%. Based on this comparison, Aeon net profit margin improved slightly from 2.686% in 2022 to 2.781% in 2023, reflecting better management of non-operating expenses such as tax and interest. This marginal increase highlights the company's resilience in a challenging economic environment. Next is return on asset. The formula that we use is net income divided by total asset. For the year 2023, the answer is 2.198%. For the year 2022 is 2.050%. Aeon return on asset increased from 2.050% in 2022 to 2.198%, indicating improved efficiency in utilizing assets to generate profit. This improvement likely results from better asset optimization, including investment in property management service for malls. The last is return on equity. The formula that we use to calculate this is net income divided by ordinary share. So for the year 2023, the answer is 6.177%. For the year 2032, the answer is 6.156%. Aeon return on equity remains stable, rising slightly from 6.156% in 2032 to 6.177% in 2033. This reflects control of financial leverage and reduced debt burden, ensuring steady equity return. The consistency of ROE signals profitability and can attract investors, also enhancing the company's ability to raise capital.
Now, we are going to make a comparison between the Aeon's company current ratio and quick ratio with the industry current ratio and quick ratio. Let's start with the current ratio. Current ratio usually measures a company's ability to cover its short-term liabilities using short-term assets. So as for Aeon, the current ratio is 0.513 times, which is significantly below the industry average of 1.58 times. This indicates that Aeon may struggle to meet its short-term obligations compared to its peers in the industry. A current ratio below 1 means Aeon's current liability exceeds its current assets. This can raise potential liquidity concerns. This could be an area where Aeon needs to monitor closely to avoid financial pressure. Now, moving on to the quick ratio, which focuses on the company's ability to meet short-term liabilities using its most liquid asset, excluding inventory. Aeon's quick ratio is 0.139 times compared to the industry average of 1 time. This highlights Aeon's limited capacity to meet its short-term obligations using only liquid assets like cash and receivables. It also suggests that Aeon relies heavily on inventory or less liquid current assets to support its operation. This can be another indicator of potential liquidity challenges that Aeon should address to remain competitive in the industry. In summary, both the current and quick ratios reveal liquidity concerns for Aeon compared to the industry average. Improving these ratios could strengthen Aeon's financial health and its ability to handle short-term obligations more effectively.
Thank you, Ms. Nadia from NDTV. Now, welcome back to PPTV. Let's compare the Aeon's latest inventory turnover with the industry. In 2023, Aeon's inventory turnover was 7.462 times, exceeding the industry average of 7.1 times. This indicates that Aeon managed its inventory more efficiently than its competitors. A higher turnover reflects stronger sales or more effective inventory management, showing that Aeon optimized stock levels, reduced the holding cost, and improved the competitiveness. It also suggests Aeon responded better to market demand compared to the other competitors. In conclusion, Aeon's inventory turnover of 7.462 times highlights its superior efficiency in meeting customer needs while minimizing cost, giving it a significant competitive edge. And now, over to Miss Julia from SYTV.
What a great explanation, Putri. Hello, I'm back. Now let's take a look at the comparison between Aeon and the industry. Aeon company debt ratio in 2023 is 64.411%, which is lower than the industry average of 75.3%. This shows Aeon relies less on debt to finance its assets. With total debt of 3,364,531,000 ringgit and total asset of 5,223,543,000 ringgit. Aeon is less exposed to challenges like rising interest rates or economic downturns. Compared to the industry, the company could slightly increase its debt to fund growth. Its current balance ensures financial stability. Now I will pass it over to Atika from HA TV station.
Thank you, Julia from SYTV for the report. Next is about profitability. The net profit margin measures how much profit the company earns for its revenue. For Aeon, net profit margin of 2.781% falls significantly below the industry average of 6.16%, indicating lower profitability after covering expenses. This suggests the need for the better cost control, efficiency, and revenue optimization. While Aeon's reliability is evident, its lower margin may concern investors seeking higher return, as is a lag behind industry peers in converting sales into profit. Finally, the return on equity measures how effectively company use shareholders' equity to generate profit. For Aeon, return on equity (ROE) of 6.177% surpassed the industry average of 5.25%, reflecting strong shareholders' return and effective debt management in 2023. By reducing borrowing, Aeon improved its cost structure and retained more profit for shareholders. This efficiency in utilizing shareholders' funds made Aeon attractive to investors seeking stable returns. Despite challenge in its net profit margin, the company demonstrated effective resource leverage to deliver value.
Alright, now I will continue by explaining the three strengths of Aeon company. First, its return on equity of 6.177% exceeds the industry average of 5.25%, showing effective management of resources and strong returns for investors. This makes Aeon an attractive choice for future investment. Second, its debt ratio of 64.411% is well below the industry average of 75.3%, highlighting sound financial management and a reduced reliance on debt. This stability allows Aeon to explore growth opportunities without significant financial risk. Third, Aeon inventory turnover ratio of 7.462 times outperformed the industry average of 7.1 times. This efficient inventory management ensures quick product movement, lower storage costs, and better responsiveness to customer demand. Next, we'll be explaining by Nadia from NDTV station.
Thank you, Julia from SYTV for the report. Now, I will proceed with the weaknesses of the Aeon's company and the first two suggestions for the company. First of all, the company is facing weak liquidity positions. This is because Aeon's current ratio 0.513 cents and quick ratio 0.139 cents are significantly below the industry averages. This indicates a weak ability to meet short-term obligations, which could lead to financial strain and impact the company's operational efficiency. Next, the company have high dependency on inventory because from the calculation that have been made, the substantial gap between the current and quick ratios suggests that Aeon heavily relies on inventory to meet its liabilities. Now, what I can suggest to the company is to improve its cash flow management, because by improving its cash flow management, Aeon can enhance its liquidity by focusing on faster collection of receivables, negotiating better credit terms with suppliers, and also it can reduce unnecessary expenditures. This will improve its cash reserves and strengthens its ability to meet short-term obligations. Next, the company should also optimize its inventory level. This is due to Aeon should implement better inventory management practices, such as adopting just-in-time inventory, or also known as JIT inventory, or leveraging demand forecasting tools. This would reduce overstocking, free up working capital, and improve the quick ratio by reducing reliance on inventory. Let's now hear to Julia at SYTV as she offers her suggestions to the company.
Alright, now let's proceed for the next suggestions to improve Aeon Company. Aeon Company liquidity is a constant, with a current ratio of 0.513 times and quick ratio of 0.139 times, both below industry average. Improving inventory optimization and receivables collection can strengthen cash flow. Additionally, Aeon's net profit margin of 2.781% lagged behind the industry average of 6.16%. Focusing on cost efficiency and high margin product can boost profitability. By addressing these areas, Aeon can further strengthen its market position and shareholder value. That's all from me. Now, I will pass it over to Atika from HATV station to continue the explanation. Bye!
Overall, based on the financial ratio analysis of Aeon, for 2023, the company demonstrated moderate performance with strength in return on equity (ROE) and a stable debt structure. However, there are weaknesses that need to be addressed. To remain competitive and enhance shareholders' value, Aeon can focus on improving financial liquidity by optimizing working capital management, enhancing inventory efficiency through demand forecasting technology and strategic promotion. Also, improving profit margin by reducing operating costs and introducing exclusive products. Not only that, Aeon can also invest in digital transformation to enhance customer experience and operational efficiency. By implementing this recommendation, Aeon has the potential to strengthen its position in Malaysia retail industry and achieve sustainable growth in the long term. I think that's all from us. Thanks for watching.